Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning, everybody, and a happy Sunday to you, giving you the sincere and actionable ideas that you need to live a life of fulfillment. I don't want you to just survive retirement. We need you to thrive in retirement, and that means having a multifamily office at your disposal, because it takes something that's more complete, something that's holistic, something where you can talk about taxes, your estate modeling, your retiree health care, your investment advice, your cash flow modeling. It's all of those disciplines coming together with multidisciplinary professionals under one roof, serving the common denominator of your last name, your family. Now, hey, I talk about something all the time, which is the arc of life is dynamic. And in retirement, it certainly is. In fact, David, did you know that there's really 4 futures that you need to plan for in retirement? Well, David, of course, I know you know this because we talk about it with clients all the time. So I'm going to get us started, because when you're doing retirement planning, there's future number 1. And future number 1 is your expected retirement. It's a world where your life, your retirement date, all proceeds as planned. And David, talk to us a little bit about what it is that you're doing with clients of VestGen Wealth Partners to prepare for that core retirement, setting a date, setting the income. What are the steps that are there? And I'm going to make sure I bridge us into talking about the 3 other potential futures and how we're solving for such.
Yeah, I like to start with the end in mind. So where do we need to be at this specific date? What's our cash flow going to look like? What's our Social Security, pension income going to look like? And then what are the steps that we need to take to get you in a spot to be successful? So we've got to set that goal first. And we know in financial planning, you never deal in absolutes. So what are the small strategic steps that we're going to take several years before retirement to get things in a place that's going to be optimal and efficient? And that has to do with how we're allocating portfolio solutions, and then really digging into what's the tax environment going to look like when we retire. So it's not just about, Social Security amounts that we see on those benefit statements. It's Social Security, less federal income taxes, less Medicare premiums. And part of our job, I think, Craig, is just trying to create clarity around those different ideas so people know what to expect and what it's going to look like. Because if we have to pivot and make some changes, better to do it a few years out from retirement than a few weeks out from retirement.
Well, and let's talk about that professional pivot, the professional pivot, not you changing your job, but the professional pivot, meaning that your retirement might not be at the age that you planned. Your retirement might not be for the reasons you planned. In fact, there was a recent study that said, 70% of retirees, 70% say retirement went as planned, meaning they had agency over their date. Well, that means 30% of the time, it doesn't go the way you thought. So let's listen now. We're talking about these 4 futures when it comes to retirement planning. The first one is, the expected retirement. David just talked about that. It's easier to plan around. But what about number 2? The feared retirement. And the feared retirement, you already know, listeners, that's the scenario where something breaks. It could be your health. It could be your finances. That's a nice way of saying reduction in force. global outsourcing, you lose your job at a certain age when you were just making the most money you had ever made at any point in time in your career. You were paying down all of your debt, stashing money into your retirement plans. The kids were off of payroll, and you were 3-4 short years away from getting access to retiree healthcare from Medicare, and then it all gets ripped away from you. David, as a practitioner, how do you future-proof with clients at VestGen Wealth Partners for what could be that feared retirement date?
Well, I think the first thing is to be honest that that's a possibility for a lot of people, right? Especially in the corporate world where you don't always have control. You can be a top performer, but get replaced with someone who might be a little bit cheaper on the pay scale. So we're honest with those situations, and then we build it into the plan. So I think financial planning from VestGen today is, here's the core, here's what we're planning on, but here's plan B, C, and possibly D, which is, what if we have to go out 2 years before we're expecting? What does the cash flow look like? How are we going to handle retiree healthcare? I mean, no matter what, I still think that is one of the biggest challenges that most families are dealing with, is if we don't have the opportunity to bridge immediately into Medicare, where is the money going to come from to bridge that gap? Perhaps it's COBRA, perhaps it's some type of private insurance through the ACA. But that's what the plans look like today, is there is a contingency. And we have to be honest that that's a possibility. Now, on the other side, right, we certainly have plenty of clients that have a goal. They get to that goal and they say, you know what, I want to keep going for a year or two. And that's great to build up some additional reserves just as a safety net. Because I think part of that is once you know you've made it and you circle that date on the calendar, you've gotten there, that relieves that burden, that stress. So maybe you do want to work a little bit longer to build up those reserves. But our job is to plan for the worst case scenario, which is we get out a little bit early. And those are real conversations that we need to have, just like there's real conversations we need to have about some of the assumptions we're using in these retirement plans.
And David, that's a great segue that if you need some help and you want to learn more, pick up the phone and give us a call, 833-964-PLAN. That's 833-964-PLAN. Take advantage of a complimentary consultation so you too can begin to future-proof your retirement. Because remember, there's a total of 4 futures that you need to plan for when it comes to retirement planning. We just got done talking about the expected retirement. We then mentioned, of course, the feared retirement. Well, there's a number 3, and I call that the disciplined retirement. And someone's going to say, what do we mean by that? I want to acknowledge something. So many people die with the most money they've ever had exactly at the point in time they don't need it. Let me say that again. So many people die with the most money they've ever had at exactly the point in time they don't need it. And that disciplined retirement, which is what I've nicknamed it, comes from the fact that there's a lot of people who actually struggle emotionally with the transition from saving to spending. And every dollar that is left in those accounts as a legacy also needs to be viewed through a lens of a dollar of experience that's forfeited. David, talk a little bit about the real life struggle that you as a practitioner see with clients as they sometimes transition from being a saver to being a spender. And what are some of the specific tools and techniques that VestGen Wealth Partners does to generate the income so that people can feel more free to overcome that hurdle and spend?
The vast majority of our client base built their wealth the old-fashioned way, which is good old-fashioned sweat equity, which means they were very disciplined with their savings into 401ks and brokerage accounts. And as they make that transition into retirement, a lot of them hold on to that money with 2 hands. They don't want to spend, right? So it is difficult, but I do think we're seeing a change. And that change is that perhaps the end goal is to not die with the highest account balance and Craig, I think people are listening to that message of perhaps we want to create some of those experiences ahead of time, so accelerate some of that gifting. But gifting comes in different ways. And I had a conversation with someone the other day, and we were talking about the fact that we might need to accelerate gifting to the children and grandchildren to lower the value of the estate. Well, it's one thing to just gift money or give money to a child or a grandchild. It's another thing to go out and pay for a family trip, to get everybody under one roof, to create those memories that everyone is going to carry with them throughout their lifetime. That's another way of gifting. So we have structured gifting, which is often done for tax reasons. And then the other form of gifting is just that family time and using the money now to help the kids out to get ahead or to create those family vacations. And I think there's different ways, and perhaps after the break, we can talk about different ways to gift, whether that's funding retirement accounts, whether that's funding trust accounts for the kids, whether that's funding college savings accounts. There's so many different ways to do it, but I think there's different levels of gifting.
Or David, whether that's funding Trump accounts on the 4th of July. So, hey, there's your plug. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. I want you to download today our guide to Trump accounts, how to optimize retirement savings for young children. That's available for free at getretiredstayretired.com. Your guide to Trump accounts, how to optimize retirement savings for young children. We've been talking in the A block and it's spilling into the B block about your 4 potential future retirements. Number 4, what I call the transformed retirement, that's coming up next. Craig and David in the know, VestGen Wealth Partners.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
A lot of what we do at VestGen Wealth Partners is future proofing. And remember, there's 4 potential futures when it comes to retirement. Maybe everything goes as planned. We call that the expected retirement. Maybe there's the feared retirement, a health issue within the family, a job loss from a RIF or global outsourcing exactly at the time you don't need it. There's the struggle of the disciplined retirement, giving yourself agency and guidelines to actually spend money, because transitioning from a life of savings to a life of spending can be difficult. It honestly can, but we solve all of those through a deep-rooted commitment to financial planning, cash flow modeling, all backed up by a very robust investment platform on a fiduciary standard. But what about future number 4? I refer to it as the transformed retirement. It's the future you just didn't even plan for. And one of the things I'm seeing as a practitioner is more and more people going through what's called gray divorce. Divorce is not a young person thing. Divorce has become an everybody's thing in America. And when you take a couple who gets divorced later in life, aka their 60s, which is happening because sometimes the last children, if you had clients a little bit later in life, don't launch. And then all of a sudden, the last child launches and mom and dad are sitting around and they go their separate ways. And I've got to tell you, running a household in retirement that's a combined family, a heck of a lot easier than having to cut everything in half and having people go their own way. So I think what this means is you have to be honest. You should never do a retirement plan based on divorcing your spouse, but it's very tough to make predictions about the future. And that's why you've got to build retirement plans that can survive your worst fears, running out of money. Retirement plans that can adapt to life's surprises, both those positive and those are negative, because you're far more likely to enjoy your future when you know you've planned for all these different pivots. And David, That's why I think people need to go beyond simple goals-based planning. People need to move into cash flow-based planning. And people oftentimes need to also create what I call a set of guardrails, right, David? Guardrails, the upper band of what we can spend, the minimum of what we should be spending. David, how do you use that concept as guardrails with clients of VestGen Wealth Partners to help them feel confident that they can navigate through a very diverse set of future issues?
Well, this is why financial planning is not static, right? So we build the plans prior to retirement, but then those plans get adjusted typically every 12 to 18 months because account values change and distribution rates might change. So to your point, we're saying here's the minimum we're likely going to spend. And on the top side, here's pushing the envelope a little bit. And then we're readdressing that every year. And how we readdress that could have to do with vacation. It could have to do with helping out the kids. But the idea is once we set those initial guardrails, we do have to move the goalpost a little bit because markets, economies, and spending habits will change, which is what I was alluding to before the break, Craig. I think one of the really important things about financial planning today is if you're working with someone, they should have an opinion on things. They should have an outlook on the market. And I think one of the big challenges we're going to see is some of these really basic computer models. When you log into your 401k, it says, this is how much money you're going to have when you retire. But they don't actually tell you ever what the assumptions are that they're using. And I don't know about you, but we've had 3 good years in the stock market. And we are not bearish on the market, but what we understand is based off valuations, based off GDP, it's likely that those returns start to moderate. So when we are doing our retirement simulations, perhaps we should use those more moderate returns and build in some other scenarios from an investment standpoint, because it's not going to be all roses moving forward. We're long-term believers in the market, but we understand that stock markets aren't linear. And I think that's a major challenge for retirement planning, because I'm sure you've seen that as a practitioner, Craig. Folks come in, they have a plan someone ran, and then when you actually look at the back pages, you're like, well, wait a minute, I'm not sure these assumptions are actually realistic.
And let me challenge those assumptions right now. A lot of these assumptions based into 401k plan websites, like David just mentioned, they have you dying at 82 or 85. And maybe you're saying to yourself, my parents, my aunts and uncles never made it past the age of 82 or 85. But I would challenge you, what if you select against the average? What if you had the opportunity to earn a good income, which gave you good access to healthcare, which gave you good access to awareness, and you had an adult active lifestyle, and you do live 3, 5, 7 years beyond the average? Number 2, David, how often do you see recency bias in those calculators? They assume that how someone is invested now is how they're going to invest over time. And if you're using a calculator, or you not knowing your online calculator simply imports the return from the last 5 to 7 years, you could be overestimating what your future returns will be. And then you got to talk about inflation. Come on. How many of these online calculators are running inflation models rooted in 2.3 to 3%? Because we spent a long period of time with benign inflation in America, only to find out that if you print too much money, inflation comes back and bites you in the you-know-what. So you deserve something better. You deserve something customized to you. 833-964-PLAN. That's 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. GetRetiredStayRetired.com. You have to download our Investment Outlook 2026. Download that Investment Outlook 2026 today, because there are higher stakes. There are higher valuations. This year is anything but dull. That's our investment theme for the year. And while you're at it, Download your guide to Trump accounts so you too can optimize retirement savings for the next gen. Now, David, next generation planning, it's really critical. And even think of our corporate name, VestGen Wealth Partners, Vest, to be vested in the success of our clients through a strong and robust investment discipline. Gen. It's not just about us, it's about the generations. It's about making sure that grandma and grandpa, mom and dad, and the adult kids are all on sound financial footing. Because if you find yourself in the middle, your parents aren't well, your adult children aren't well, then you too can't be well. So it's planning across generations. There was a lot of thought that went into that name in our transformation to VestGen Wealth Partners. And a lot of people start to realize that they don't want to just leave their money to their family through their estate plan at death. They want to empower that family today. And David, talk about how VestGen Wealth Partners coaches people through RAKs, random acts of kindness. What are those to get started?
Yeah, random acts of kindness are what I call not keeping score. So keeping score is structured gifting where perhaps we're treating everybody equally and perhaps we're gifting money to our children or grandchildren in a very structured manner at the same time every year within certain boundaries. Random acts of kindness, though, are treating people fairly, helping out the kids or grandkids when they need help because we understand everybody's in a different position. But as we've talked about, even with Trump accounts, Craig, I think what you're starting to see happen is people say, look, I don't want to just give my child $19,000 and they go do whatever they want with it. But perhaps I start helping them fund their Roth IRAs. Or for every $2,000 my child puts in, I'm going to match them $2,000 under the agreement that this is long-term investment capital. And everybody out there understands the power of compounding. And if we're doing that for someone that just graduated from college and they put in, $7,000, $8,000 into an investment account over 5 to 10 years and just let it grow for the next several decades, think of the massive head start that they're going to create. And it's also about creating good habits. So by doing like a simple matching program, right, then you are encouraging them to save and you're teaching them about that eighth wonder of the world of how if you let investments sit in great companies of America, you will be rewarded over time.
So when we come back, we're going to talk about random acts of kindness, then how you can start graduating into gifting, but gifting with a purpose, and then how you can move into structured gifting, and then how you can do gifting on steroids. All right, here's what I want you to do. I want you to connect with us online at GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Listen again, there's higher stakes coming from higher valuations. This year's anything but dull. Download for free today our Investment Outlook 2026. And don't forget, download that Trump account guide, optimizing retirement savings for young children. All of that is found at GetRetiredStayRetired.com. You're listening to Craig and David Bolanos in the know. VestGen Wealth Partners on AM 560. The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
All right, you're at that point in life where you acknowledge you're playing the back nine. I'm not talking about golf. The weather's not yet good in Chicago. I'm referring to a certain age, a certain intersection where you're comfortable enough with your own finances because you have done your retirement plans with VestGen Wealth Partners, which then allows you to start helping the next generation. David mentioned treating kids fairly. Fairly doesn't mean equally. Fairly means recognizing our adult kids are in different circumstances, and that's where RAKs, random acts of kindness, come in. You pick up the dinner bill, you help with some activities. Maybe you do this, maybe you do that. You're not keeping score. That's a random act of kindness. But then it comes to wanting to do something more for everybody. And as David said so eloquently in the last block, gifting with discipline, gifting with purpose. And I think the first thing is, remember, education leads to empowerment. Let me say again, education leads to empowerment. And that's why we love, and I encourage you to get involved with us in selecting a 529 college savings plan. Why? Because you own it. You control it. You own it, you control it. You heard that right. And whenever you compare gifting with tax leverage, removing money from your estate, getting a state tax deduction above the line, if you're in a right state that gives you a tax deduction or a tax credit, how could you not want to do that? So whether it's getting started with the 529 plan, whether it's getting people involved by helping them fund Roth IRAs, right? I'm not writing Connor and Gavin a check. I write Connor and Gavin a check made payable to their Roth IRA because they know our expectation, those are my adult children, by the way, is to grow their capital base over time so they too can grow their income. But David, you've got young kids. My kids are unfortunately over the age of 18. You say everybody gets a Trump account. David, why is everyone getting a Trump account?
Well, don't we want to invest in tax preference accounts? I mean, having that tax deferral is a huge benefit for investing. So, I think some people look down on the Trump accounts, perhaps like the contribution limits weren't super high, but because we're able to start at such a young age, that's a massive leg up. So everybody should be thinking about it, and grandparents should be encouraging their children to take a look at those accounts and make sure they get funded for their kids. The other thing I wanted to talk about, Craig, is how we source money for gifting.
Well, before we do that, the source, let's make sure we follow through on our promise. We did random acts of kindness. Then we started gifting with discipline to accounts that the grandparent or mom and dad own and control, the 529 plan. Then we evolved into funding Roth IRAs through a purposeful gift. Then we're talking about layering in a tax sheltered opportunity that might also come with free money, courtesy of Trump accounts, depending on the age of the minor. And then we have to start looking at structured gifting. David, you called it the annual gift. And David, you're going to talk about the annual gift. I'll talk about the lifetime gift. What's the annual gift exclusion and how can people use that?
Yeah, so the annual gift exclusion for 2026 is $19,000 per individual. So we can gift someone $19,000 without having to file any special tax paperwork. And if we have mom and dad could each gift $19,000 to a child. So we're looking at a much larger gift. Now, when we gift money, we could gift cash. And I think that's what most people think about. But Craig, we have a lot of clients that have appreciated assets in portfolios, in their trust accounts. And so sometimes mom and dad say, I'd like to gift my children this money, but then I have to sell my appreciated stock and I have to pay a capital gains tax on that. And I don't want to pay the capital gains tax on my particular stock holdings. What if we just gift the shares in kind to the child? So instead of you selling the shares, perhaps we push those shares in kind to the child's account under the annual gift amount. And if the child decides to sell them, well, they'll pick up the capital gains tax, but it's likely they're in a very low capital gains tax rate, if any. So we get to accomplish two things. We get to rebalance your portfolio, and we get to move shares into the next generation. And if you own a stock that you're bullish on, well, perhaps your kids will be bullish and they'll just hold those shares for the next several decades as well. I think that's a really great way to start moving dollars to family members that's tax efficient.
And that's how VestGen Wealth Partners links investments with strategy, because it's all about creating tax leverage. So again, I've oftentimes joked that my adult children went to school on 529 plans. They went to school on scholarships they earned with merit, but they also went to school on Mr. Softy, shares of Microsoft, because in 2026, if someone's income is under $49,450, the capital gains rate, David, is how much?
Zero.
And if your young adult got married, but their combined household income is under $98,900, their too capital gains rate is what, David?
0.
So if your capital gains tax rate's 15 or 20%, but the kids are at 0, that's 15 to 20% tax leverage. So don't just gift with the checkbook, gift with purpose and intention, looking at all of your resources, because that is tremendous leverage. Now, there's also a lifetime gift. This might sound pie in the sky, but it's not. Maybe your daughter is going to bless you with the very first grandchildren in the family. Maybe they live in South Central Wisconsin, but you want them to come back to the city of Chicago. There's a housing cost difference. Maybe you want to gift more than that $19,000 limit allows. You know what? You can absolutely do that, because the lifetime gift exclusion is currently $15 million. So if you want to write a check to somebody for $200,000, here's how it's going to go. You're going to go ahead and write them a check for $200,000. The first $19,000, that's the annual gift exclusion, and you're going to take $181,000 off your $15 million lifetime gift exemption. If you do it that way, you pay no taxes. The kids pay no taxes. It's an easy way to start transferring wealth now, as opposed to transfer wealth at death. Wait, I know what you're thinking. Your head's blowing up. We talked about random acts of kindness. We talked about gifting with discipline and intent. We talked about structured gifts. I just made a mention of how you can use gifting on steroids, courtesy of the lifetime gift exemption amount of $15 million. And David used one simple concept of linking taxation with investment, with gifting strategy, to take advantage of that 0% capital gains rate for those who are making less than $98,000 or $49,000 in 2026. You do deserve to learn more, and you can. Pick up the phone and give us a call at 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. We do this because we've got the heart of teachers. David, why does a good wealth advisor have to have the heart of a teacher? And why is that unique to our bloodline and our family?
Financial planning is an endeavor in education. And our job is to create clarity for families so they know all of the options that are available, and then they can make a decision on how they execute based off their personal value system. Our parents were teachers. One was a chemistry teacher, one was an English teacher. So I think that's in our blood. We just do that education in a different venue and in a different environment. But if you're working with folks right now who say, this is the only way to do it and we have the best way to do it, I think if you listen to our radio show, you understand that there are several ways to execute. And as long as you are tax efficient, low cost, and you're thinking 2 steps ahead, that is what a good steward of capital does. And that is what we do very well at VestGen Wealth Partners.
833-964-PLAN, 833-964-PLAN, the website, getretiredstayretired.com. That's getretiredstayretired.com. You're listening to Craig and David Bolanos in the know. VestGen Wealth Partners, AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
It's always been and always will be about TIR. TIR meaning taxes in retirement. And remember, tax planning is more than just filing a return. It demands strategy. There's new rules, new opportunities. They're always emerging. Case in point, on July 4th of 2025, the Tax Cut and Jobs Act was expanded. It was enhanced. It was called OBA, the One Big Beautiful Bill Act. And as we come into that deadline for filing income taxes, a couple things you got to be paying attention to, not just for 25, but into 26. Remember, it's not too late. Maybe you're on the cusp of getting the new $6,000 per person senior deduction. You might be right on the cusp. There are some things you might be able to do still in 26 to save money on 25's return. Maybe you had the ability to contribute to a health savings account, but you didn't. Maybe you should. Maybe that contribution to the HSA will lower your taxable income to allow you to qualify for that deduction. Gone are the days that it used to be that you couldn't contribute to an IRA past the age of 70 and a half. David, can you do that now?
Yeah, you can. And if you have a part-time job and you have enough income, you can even fund an IRA for yourself and perhaps even your spouse. And if you have, I just had this happen the other day, Craig. We had a client with a small balance due, funded some IRAs, erased their balance due, brought them under the limit for IRMA. It was a double whammy in a small thing, but massive changes and efficiencies created by just doing that very last minute.
Just moving money from pocket A to pocket B to unlock deductions, such as the $12,000 deduction for married couples. If you're 65 or older, know the income, know the rules, and use all the tools and techniques that you can to put more money in your pocket. Now, speaking of new things, wait a second. Did I miss this? You can deduct car loan interest up to 10 grand right now. Did you know that? No, maybe you didn't. Keep in mind, guys, you can actually get a deduction for auto loan interest. This doesn't mean run out and go buy a vehicle, but it means if you check the window sticker and your final assembly point for that car was in America, you've got an interest loan deduction coming your way, but you might forget to take it because it wasn't on last year's return. And David, isn't that the danger? So many people simply import what they've been doing last year into this year. They assume it's the same. They're lazy sometimes. It's human nature. We all are. You just import the answers to the questions, and then you miss the fact that we overhauled the tax package. David, how are you working with clients to create awareness on all these different things, like the increase in the SALT cap, the new change to the deductibility of interest, the fact that tip and overtime income might not necessarily be taxable? The list goes on and on and on. How do you help your clients make sure they maximize value?
Well, part number one is we talk about it before it actually happens, right? Because what you're talking about, Craig, came out last summer. So part of our job as educators is to make sure people understand those rules. And while this legislation is probably hundreds of pages long, there are really only 4 to 6 things that changed for Main Street investors. And it's walking people through what will benefit them and what might benefit perhaps their neighbors or their children, etc. But now that we're in tax season, it's going back and making sure we understand that. So you had mentioned the SALT cap. That generally is good for folks that are actively engaged in the workforce. You mentioned the senior bonus deduction. That's for folks that are 65 and older. But let me tie one of these things together. So one of the things I think is really interesting is you had mentioned certain families don't pay capital gains taxes. So they don't pay a tax on the sale of an appreciated asset if their income is below a certain level. Well, a good trick for that is if we know we're not going to pay any capital gains tax, why wouldn't we sell an appreciated asset and then buy a similar asset back, reset our cost basis, right? So that we don't have these large embedded gains moving forward.
Wow, that's mind-blowing. David, I want to slow it down for a minute. So maybe someone retired at the end of 2025, and a part of their plan for 2026 is to keep their income incredibly low so they can get premium tax credit subsidy for their health care while they wait to get into Medicare. So you've already worked with that family to structure amounts of tax-free income, municipal bonds, and disciplined cash reserves. For a family like that, how are you going to use this uniqueness in the tax law to reset cost bases on, say, shares of the NASDAQ 100 that have grown in value?
Right. So if our income is low enough and we qualify for a 0% capital gains tax rate, I would be willing to take a profit on the NASDAQ 100. So sell it, but because I don't pay any capital gains taxes, it's not really an event. Then I rebuy that. And now my new cost basis, right, is much, much higher. So that in the future, if I have to make another sale in that same type of investment, I have a much smaller embedded gain. So we call that resetting our cost basis. Now, again, that's not applicable for everybody, but for certain folks who are probably recently retired in these golden years where we have a lot of flexibility, these are the small changes that you can make in non-qualified investment accounts that will pay long-term benefits. And the devil's in the details, and you have to be forward-looking. But this is a great example of winning at the margins, because that's what financial planning is. It is not about making wholesale changes. It's consistently adding value at the margins. And this is one really good example of how to mix your investment allocation with your tax return.
833-964-PLAN. 833-964-PLAN. Connect with us. Take advantage of the things we talk about in this radio program. The radio program is designed to empower you with education. Meeting with us for a complimentary strategy session is to allow you to start putting some of those things into action, because you can't just have IQ. You can't just have intelligent quotient. You also need to have the other form of IQ, implementation quotient. So you can take these things that you hear about, apply them to your situation to create marketed improvement for yourself and your loved ones financially. Connect with us. GetRetiredStayRetired.com. That's the website, GetRetiredStayRetired.com. Download today our Investment Outlook 2026. There are higher stakes coming from higher valuations. Anything but certain is the outlook for this year. And optimize those Trump accounts for the next generation. They go live on July 4th. That's only 2.5 months away. You too need to know what you can be doing to empower what happens when a 529 meets an IRA for the next generation, not being subject to earned income. These are all tremendous opportunities. So whether it was the new senior bonus deduction, the expansion in state and local taxes, which I can tell you has so many more clients than normal, going back to itemization, which means if more people are going back to itemization, then what are you doing to accelerate deductions and bunch them into a certain year, then take a year off, then accelerate deductions and bunch into a certain year? We're right back to where we used to be. This is all tax planning, but all the tax planning that you do adds incremental value to the bottom line, and $1 saved through taxes is $1 of leverage for you and your loved ones. Okay, you know where to find us. GetRetiredStayRetired.com. You've been listening to Craig and David Bolanos, VestGen Wealth Partners, on your favorite station. We've got all the answers. That's why we're affectionately nicknamed AM 560, The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
You know, investing is and always has been a funny thing. If you bet on America, you will win long term. But we oftentimes say at VestGen Wealth Partners, you always, absolutely always, get a second chance to do the right thing. That second chance is rooted in technicals. I call them Fibonacci retracement levels. But David, as we close out today, share with everybody this very important message of what it means to always get a second chance with the S&P and Dow Jones within striking distance of all-time highs.
Yeah, if you've been paying attention, we had a massive relief rally last week with this temporary ceasefire. And I think what that means for investors is this is another opportunity for you to rebalance. If we go back to our 6 for 26, the first thing we had talked about is you fix the roof when the sun is shining. And if you're sitting there thinking, geez, we've done really well over the last 3 years, I think we've made it to retirement. You want to make changes in your portfolio as asset prices are appreciating, not going down. Well, we're back in the green for the year. And if the market volatility over the last 60 days has made you nervous, our suggestion is sit down and figure out how you're going to recalibrate your portfolio. Because if you're going to sell appreciated assets, you want to sell them into this upward moving market. If you need to take the edge off, but you're not sure where to put those proceeds, then give us a call or go to our website, getretiredstayretired.com. Because if you're worried that you're just going to sell your stocks and buy some bond mutual fund and you want something different that's not vanilla, then you've got to work with a firm that has the resources and opportunity set that's uniquely customized to you. If you're sick of just buying a mutual fund and buying another one with the proceeds, we're here to tell you there's a different way to do it. But those ways are always rooted in financial planning. So what's our goal? Where do we need to get to? And what are the small strategic steps that we're going to take to go from a place that's okay or good to eventually optimal? GetRetiredStayRetired.com. What we offer is a cup of coffee and a second opinion. So give us a call today. You're listening to In the Know with VestGen Wealth Partners on AM 560, The Answer.